China is not approaching a banking trap. It is already inside one. And what matters now is not the headline about slower growth. What matters is the balance sheet constraint underneath it. When the largest banking system in the world begins protecting margins instead of expanding credit, that is not stimulus. That is compression. What we are seeing is a structural profitability squeeze. Funding costs are being nudged lower through policy facilities, yet lending rates are not falling proportionally. That divergence tells us banks are defending spread, and when spreads are defended, lending capacity tightens. This is the mechanism markets often misread. Lower rates in a healthy credit system can stimulate. Lower rates in a capital-constrained system reduce earnings power. And earnings power is what allows banks to absorb bad loans. Without it, they lend less, not more. January, typically the strongest lending month in China's calendar, showed loan growth slowing towards 6% year over year. Just 2 years ago, that figure was above 10%. At the same time, regulators are expanding oversight of systemically important institutions. Official non-performing loan ratios remain stable, yet regulatory posture is tightening. That combination suggests containment, not resolution. Research into past lending cycles shows that quota-driven month-end lending spikes were materially more likely to become bad loans, particularly among state-directed enterprises. When credit allocation prioritizes activity over return, capital quality eventually deteriorates. And once capital deteriorates, policy easing alone cannot reverse it. Within our strategy framework, this aligns most closely with a prolonged Phase 2 compression regime. We currently assign roughly a 60% probability that this constrained credit environment persists through mid-2026. There is approximately a 25% probability that visible recapitalization or overt monetization shifts conditions before year-end. A more acute restructuring scenario carries around a 15% probability over the next 12 months. Now, before we go further, a brief note. This discussion is educational and analytical. It is not investment advice. Our focus is on mechanisms and probabilities, not prescriptions. If this kind of structured macro breakdown helps you think more clearly about credit cycles and liquidity sequencing, consider subscribing. The goal is not prediction. It is to give you a repeatable framework so you can interpret these shifts with more confidence and less noise. The confirmation signals we are watching are straightforward. Continued deceleration in loan growth, despite lower funding costs, would reinforce margin defects behavior. Additional regulatory tightening would support the hidden asset quality thesis. A formal reduction in national growth targets would signal acceptance of slower trend expansion. The invalidation would require transparent recapitalization, meaningful write-downs, and renewed private sector credit expansion without compressing bank profitability. Absent those conditions, China's system resembles a slow-moving balance sheet adjustment rather than a reflation engine. And when 1/3 of global banking assets are operating under constraint, that influences duration, commodities, and dollar liquidity dynamics worldwide. Our strategy remains disciplined. We follow signals, not narratives. When bank capital is constrained, credit slows. And when credit slows, growth expectations eventually adjust.